Welcome back. Markets this morning are rallying. We're near the highs of the morning. The Dow Industrials right now up 455 points. The Dow is up about 1% as the Nasdaq is up almost 1%, 187 points. The S&P higher by 59, almost 1% as well. Of course, Wall Street is wrapping up the worst quarter in 4 years. The major indices sliding into correction territory, down 7 to 8% in the last 3-month period. Oil prices have surged, better than 50% higher since this war began February 28th. Oil prices right now are trading higher again. The price of Brent at $115.58, up 2.5%, and the price of crude is at $104.14, up 1.33%. The Wall Street Journal reports that President Trump says he is willing to end the war in Iran, even if the Strait of Hormuz remains closed. The administration now looking to allies to help reopen shipping lanes, as that has been the choke point of this issue. Joining me now is the chief economist of ExxonMobil. He is the former White House Council of Economic Advisors chairman, Tyler Goodspeed. Tyler, great to see you. Thank you so much for being here.
Good to be with you, and in person.
Yes, and in person, and congratulations. You have a new book out. We're happy to talk about that. I want to get your take on the backdrop here, though, because you've studied the economy for a lot of years as your role in the White House and now, of course, your new role. Do you believe that the spike in oil prices can, in fact, cause a severe growth decline?
Well, Maria, one of the things that you learn when studying 4 centuries of economic recessions on both sides of the Atlantic, I cover 132 recessions, is that it tends to take a lot to push a large, diversified economy into a period of outright contraction that's spread across sectors. It involves net employment losses. And if you look at some of the recessions that we've had over the past 80 years since the end of World War II, it's a bit like the murder on the Orient Express, that there tend to be multiple accomplices to the murder of economic expansions.
Okay. And with oil prices where they have been, I mean, that is going to create all sorts of disruptions across the world. We spoke yesterday with Dan Yergin from CIRA and S&P. I want to get your take on what he said. Watch this.
The Gulf region has become a major part of the world economy. There, as you say, there's fertilizer, also refined products. Big source of jet fuel, big source of diesel. And if you look at Asian prices, the price of jet fuel has more than doubled.
What's your take on how long we're going to be facing these elevated oil and gas prices, Dan?
If it's a week or two, this is manageable. If it starts to get into many weeks and into months, then this is a very huge problem for the world economy. And sorting out Iran's control of Hormuz is an absolutely critical question that has to be done. Iran cannot own the Strait of Hormuz because otherwise it will enable it to continue to do what it's doing now, wage war on the world economy.
So what's your take on inflation then, Tyler?
Well, first of all, I should specify that though the book covers a lot of energy price shocks, the book was written entirely in my personal capacity. So let's just say that my family is looking forward to having my evenings and weekends back. Look, the reality is that if you look back on the past 80 years, in any given year, there is a 1 in 10 chance of an energy-related recession in the United States. You can go back even farther to when coal was dominant, and before that, it was turf and provender. A lot of recessions are caused not by big macro shocks like a pandemic that affect a lot of sectors roughly contemporaneously and roughly equally, but rather very sector-specific shocks to sectors that happen to be very highly linked to the rest of the economy and for which households and businesses just have a very difficult time finding substitutes over a, say, 12-month time horizon, which is the typical length of a post-war recession.
So it sounds like you don't think that, given the moves in oil, that it does necessarily lead to a recession.
Look, one of the conclusions of the book is that recessions are fundamentally unforecastable, so I would hesitate to get into that business now. But when you look at some of the shocks, like 1973, like the early 1980s, those were big shocks that persisted for some time and usually were contemporaneous with other shocks like tightening monetary policy, even credit rationing. That was something that happened under President Truman. It happened again under President Carter in 1980 and was threatened under President Nixon.
And that's Fed Chair Jay Powell yesterday said that inflation expectations are well anchored despite the rising energy prices. He said that it signaled no need for rate hikes right now. When you look at the backdrop in terms of central banks across the world, I mean, we heard a very different scenario from the Bank of England last week. Compare what you're hearing from central banks. It looks like we'll see steady policy from the Fed. Are you expecting rate cuts this year?
Given recent remarks, I would be hesitant to anticipate further rate cuts. But one of the lessons that we've learned from past energy price shocks is that one of the channels through which they can be very contractionary is precisely through the central bank channel. So it's not just that consumers pull back on discretionary spending. It's not just that they pull back on durable goods purchases. It's not just that energy is an input into so many other sectors of the economy. It's also that central banks historically tend to respond to the inflationary threat of energy price shocks, and that can amplify contractionary impulses that are already underway.
Okay, so in other words, if you were to see this continue, like Dan Yergin said, for an extended period, then it would in fact lead to a sharp slowdown. Mm-hmm. Yeah. Given the current energy shock and the volatility we're talking about, how do you think investors should be thinking about risk right now? What should they be doing?
Well, one of the in the book, I liken economic fluctuations to the Anna Karenina principle. So in Leo Tolstoy's Anna Karenina, he begins with the words that every happy family is alike, but every unhappy family is unhappy in its own way. And economic fluctuations are somewhat similar in that economic expansions are broadly similar. They're recovery from prior adverse shocks, whereas every recession constitutes an economic expansion that failed in its own way. So the lesson, I think, of history is actually one that recommends your good old-fashioned investment advice, namely maintain a broadly diversified portfolio that is tailored to your age risk profile and maintain some liquid cash buffers.
I mean, that's what you write. I mean, recession, the real reasons economies shrink and what to do about it.
That's right.
So what to do about it?
So what to do about it is, first of all, do no harm. So though the state cannot end recessions, in fact, recession duration has been remarkably constant over the past, not just century, but past 4 centuries, and as has recession depth. The recessions have not been getting shorter, they've not been getting shallower. However, every recession has ultimately died of old age, with most recessions over in about 12 months, the vast majority in 2 years. However, bad policy can make recessions much worse. So we saw that to a catastrophic extent during the Great Depression, of course, and there have been other periods in U.S. and British economic history when bad monetary and fiscal policy made recessions that were already underway even worse.
All right, Tyler, we'll be watching all of that, and congrats on the book.
Thank you.
Thank you so much. Tyler Goodspeed joining us. Stay with us. We'll be right back.